is an Ask Me Anything episode today with questions like effective tax rates or marginal tax rates. Which ones matter more when we're minimizing taxes in retirement? And then how about this question? I'm almost at my retirement number, but the stock market is too crazy. Should I adjust my portfolio? And then a final question about flexible spending rules in retirement. That's flexible spending rules in retirement. Which rules are good, which ones are not good, and how to use these rules in practice. Stay tuned.
Welcome to Personal Finance for Long-Term Investors, where every episode teaches you personal finance and long-term investing in simple terms. Now, here's your host, Jesse Kramer.
Welcome to Personal Finance for Long-Term Investors, episode 149. My name's Jesse Kramer. I'm a financial planner. I work with retirees and people getting ready for retirement from all across the USA. You can learn more at planwithjesse.com. It's a Friday night here as I'm recording this episode. The babies are in bed. It's the perfect time to grab a snack and fill up the water bottle and hang out with you guys for a few minutes in this episode, this Ask Me Anything episode. Before we dive in, our review of the week is from Sam the Ham Man Sam. What a username. Sam the Ham Man Sam, who left a 5-star review on Apple Podcasts. He wrote, "This is a very helpful podcast in exploring retirement topics." I'm glad you like it, Sam. And thank you for the rating. Thank you for the review. Please send me an email to jesse@bestinterest.blog and I will get a super soft t-shirt mailed your way. So let's dive into the episode. First question is from Michael. Michael said, "Jesse, I heard an advisor say the following. When you put money into a traditional 401k, you are saving taxes at your marginal rate, the rate on your top dollar. If you're in the 32% bracket, you're saving 32 cents on every dollar you put in. But when you withdraw money in retirement, you don't pay 32% on all of it. You pay your effective rate. The first chunk is sheltered by your deductions. Then the next layer gets taxed at 10%, then 12%, then 22%. It steps up gradually. Specific numbers aside, I always thought it was the marginal tax rate, not the effective tax rate, that one should look at when evaluating Roth versus traditional contributions for retirement. Which is it, Jesse? What are your thoughts?" Michael, this is a simply wonderful question. I think it's the perfect question, in my opinion, the perfect question for an Ask Me Anything episode, because I too have heard people say exactly what you've outlined. And I think it's worth just explaining what you've outlined here. So we will restate the question in simple terms. So in simple terms, it's when we do any sort of tax planning, which tax rates do we really care about? Do we care about the marginal tax rates or do we care about the effective tax rates? Okay, so some quick definitions. Your marginal tax rate describes the tax rate on your final dollar of income. Because if you earned one more dollar, it would be taxed at that rate. Or if you removed a dollar, if you deducted $1, you would save taxes at that particular rate. You know, a high earner here in the US might find themselves in the 35% federal tax bracket for their final dollars, and that would mean that their marginal tax rate is 35%. Whereas the effective tax rate is the quote unquote average, or maybe the weighted average tax rate that you pay on your total gross income. So Michael was right when he explained it in his question, where all of us here in the US, some of our dollars are taxed at 0, some are taxed at 10, some are taxed at 12, all the way up to whatever our marginal rate is. You take the average of all the taxes that you're paying, and that's your effective tax rate. And now, of course, it makes sense then that your marginal tax rate is always going to be higher than your effective tax rate. A retiree, for example, with $130,000 in total income would have a marginal tax rate of 22%, but an effective tax rate of only 9.3%. And if I were doing analysis, or if we were looking at this situation, and if I said, whoa, you're only paying 9% in tax, or I say you're only paying 22% in tax, that's a really big difference, right? 9% versus 22%. Now, they're both technically true. 9% is the effective rate, 22% is the marginal rate, but the difference here is obviously, it's huge. It's a big difference. It very much matters. So back to the real question. The real question is, which tax rates do we care about when we're doing the tax planning analysis for someone in retirement? Think about the last example. Someone had $130,000 in AGI, adjusted gross income, and they had a 9.3% effective tax rate versus a 22% marginal tax rate. I shouldn't even say versus, because it's both are true. 9.3% effective rate, 22% marginal rate. If for this person, if we did one more dollar of Roth conversions, how much tax is created? It's not a trick question. The answer is 22 cents. That's the marginal rate. If we do additional Roth conversions for this retiree, we are creating taxes for them at the marginal rate. Our short answer to this question is The marginal rate is the only important one. We use the marginal rate when we make a decision that is at the margin, meaning that you're asking, what does one more dollar cost me? Or what does one less dollar save me? Should I do a Roth conversion this year? That's occurring at the margin. Should I take extra income now or should I defer the income to later? That's at the margin. Should I realize a capital gain this year or should I wait? That's at the margin too. Now, it's a different set of tax rates, right? The capital gains tax rates are different than the income tax rates, but still the idea is that we care about a marginal rate. Should I make a deductible charitable contribution or not? That occurs at the margin. So it's all about marginal rates. Now, as you ask these questions, it's very possible to move through multiple tax brackets, to have multiple marginal rates on those dollars, right? If you're looking to make a really, really big Roth conversion, it might fill up all of your 12% bracket, and then it could continue filling up into your 22% bracket. Thus, your true conversion rate becomes the blended average of multiple marginal tax rates, but it's not the same as the effective tax rate, right? All I'm saying there is, yeah, there are times where your tax planning might move through multiple brackets. You do start to take a blended average of them, but you're taking the blended average of the marginal rates. You're not looking at the full effective rate. And that might beg the question, well, why not use the effective tax rate? I think there's a big logical issue to anyone who uses a retiree's entire effective tax rate. And that logical issue is that the retirees' lower tax brackets, the earlier tax brackets, the tax brackets at smaller percentages, those are filled up by forced income. Most commonly, Social Security or pensions. Sometimes it's RMDs. And just like in our working years, our tax brackets are filled up by actual working W-2 income. And we need to think about it a little differently about forced income versus optional income. Forced income is unavoidable. Whereas optional income, it always occurs out at the furthest margin, right? 401k or IRA contributions during your working years, you're working stiff. Do you contribute $24,000, $500 into your 401k? Well, that's an optional contribution, and it should only be viewed on a last dollar basis. And this is why we look at marginal tax rates to evaluate those contributions in our working years. Roth conversions in retirement are also optional, and we need to use marginal tax rates. IRA distributions, pulling money out of an IRA, withdrawals, distributions, those are mostly optional. I still think we need to use marginal rates there. I suppose someone could say, but Jesse, what about RMDs? RMDs are not optional. They should be evaluated on an effective tax rate basis because they're forced income. And I'd be willing to entertain that argument. I still don't fully agree with it though, because there's a variability and an optionality associated with IRA and 401k accounts that does not exist in the same way for true fixed income, forced income like Social Security or pensions. For example, you could satisfy your RMDs via a qualified charitable distribution or QCD. Doing so would reduce your tax liability at the marginal rate. And doing so could avoid triggering IRMA surcharges, which is based on marginal income. Doing so could reduce your Social Security taxability because it occurs at the margins. So to be fair, I've heard some very, very smart, well-respected advisors who have echoed what Michael alluded to in his question. I've heard people say you should look at the marginal rate when you're saving money, but you should look at the effective rate when you're distributing that money in retirement. I think the fair conclusion there is that we agreed to disagree, or maybe we disagree on semantics. I don't think so. I think we're actually disagreeing on the substance of it. I just think it comes down to this. If your tax planning pushes you through multiple different brackets, you still do have a marginal bracket analysis. It's simply that you have to take the weighted average of those multiple brackets that you're moving through. The effective tax rate, though, which includes all of that mandatory, forced, unavoidable income, that is not the correct way to evaluate discretionary tax planning techniques. So that's my 2 cents. Thank you for the great question there, Michael. Here's a quick ad, and then we'll get back to the show. I send a free weekly email to thousands of readers that shares 2 simple things, just 2. The first are my new articles and podcasts, so you'll never miss when I publish new content. And the second is my favorite financial content from other corners of the internet, so you can see what's been helping me the most.
But Jesse, I don't want another email.
I hear you. I make this newsletter short, sweet, and full of essential information, and readers enjoy that. About 85% of newsletter subscribers are engaging with the newsletter more than once a month. They're enjoying it, and you will too. You can subscribe for free on the homepage at bestinterest.blog, and you'll get a free PDF of my white paper titled The Step-by-Step Guide to Building Your Retirement Paycheck. That's right, a free weekly email that thousands of people like you are already reading, a free white paper to help you plan for retirement, and you can sign up for free at bestinterest.blog. Now on to the next question from Aaron. Aaron wrote in, said, Jesse, I'm 45 years old. I'm very close to financial independence. I feel the need to protect what I have as I've largely achieved my goals and don't require massive growth for my life objectives. Your favorite Warren Buffett quote goes, why risk what you have and need for what you don't have and don't need? You're right, Aaron. That is a great quote. So Aaron asks, how do you decide whether to make asset allocation adjustments based on extreme market situations like what we're in right now? And then do you take valuation metrics like the CAPE ratio into account when deciding whether to maintain a higher portfolio value than planned as a risk buffer? Having $1 million in 1999 would have played out very differently than having $1 million in 2002. Aaron, great questions. Let me start with the first one. How do I decide to make asset allocation adjustments based on extreme market situations like the one we're in right now? So I can assume here you're talking about a few different things. You're probably talking about this 15 plus year bull market we've been on. You're probably talking a little bit about the tech mania, the FANG stocks, the Magnificent Seven, the AI stocks, maybe the AI bubble, if we want to think of it that way. Whether it is or isn't, I don't know, but just, the idea is that's what we're calling it, the AI bubble. You might be referring to the craziness over the SpaceX IPO and most likely some of these AI companies going IPO. So there's a lot of froth, there's a lot of exuberance, and the logical question is, when is this thing going to pop? I'm putting some thoughts in your head there, Aaron, but I assume that's what you're going at. And candidly, I don't really think about that. And I don't know if that makes me a dummy. I don't know if that makes me bad at my job. I think it makes me good at my job, but let me explain why I don't really think about that. Because the reason is the answer to your question, Aaron, is literally built into the asset liability framework that I think needs to be part of a good financial plan. Or at the very least, asset liability matching needs to be one of a couple different tools that you can or should use to determine what your asset allocation needs to be. Because the output from a simple asset liability spreadsheet tells you three big pieces of information. The first one is how much money you ought to have in safer, stable assets in order to cover your nearer term portfolio liabilities. Or put more simply, you're going to need more money over the next 5 to 10 years. And I personally think a lot of that money should be in bonds. The second thing that comes out of the asset liability matching framework is that it tells you how much money you ought to have in riskier investments to cover the rest of your life. So you start where that bond portion ends, say in year 10 or whatever it looks like for you, and then you plan for the next few decades after that. So in my case, those future liabilities can and should be matched to stocks. The third output, though, from the asset liability framework, the third output is where we really start to answer your question, Aaron, because the third output is called excess capital. It's money that you currently have, but that your cash flows suggest that you don't need. You have it, but you don't need it. Your plan would survive without that money. And when it comes to excess capital, that's where the spreadsheet math no longer really applies, because with your excess capital, some people say, why take a risk? I'm going to put all my excess capital into bonds. And other people say, excess capital, that sounds like house money to me. Let's take some really big bets on risky stuff. The point, though, is that the asset liability framework tells you about the bond money that you absolutely need. It also tells you about the stock money that you absolutely need. And then it informs you about the excess capital that you do not technically need. So now that we've established that, I ask you this question kind of in response to your question, Aaron. In this interesting and optimistic and possibly kind of bubblicious market that we're in right now, what has happened to the amount of excess capital in your life recently? In other words, do you have more excess capital or do you have less excess capital than you had 5 or 10 years ago? I think the answer is it's grown. I'd wager 99% of our listeners have seen their stock portfolios grow so much that they're either closer to having excess capital than they were 10 years ago, or the amount of excess capital that they have is much greater than it was 10 or so years ago. I'm saying we've all made progress. And if you find yourself in a position where you have more and more excess capital and you're feeling cautious about the market at the same time, I think the solution is clear. You can and should revisit your IPS, your investor policy statement, and consider allocating more of your excess capital to safer assets. The rationale here is that you're not putting your plan at any sort of risk by taking a different tack with your excess capital. We already established that this excess capital is money in your plan that you don't necessarily need. You can choose to dial up or dial down your risk with that money. And if you're worried about too much risk, especially after a decade where your capital has benefited from the extra risk of stock investing, I see nothing wrong if you choose to take some of that risk off the table. Short of that, I'm not really taking any different step based on market valuation. It would feel way too much like timing the market, too much like I know something that all these other people don't know. I don't know more than the market knows as a whole. I'm just a guy up here in upstate New York, but I do feel comfortable when it comes to the arithmetic and the spreadsheet work of creating a financial plan and allocating broad assets based on that plan. Maybe a final thought for you, Aaron, on that front. You might want to build some rules into your investor policy statement that you want to think about it. Of course, you want to write your IPS in times of calm. And when the market is up, you're certainly calm enough. Most of us feel much more worried when the market is down. But you might want to include some language in there and just think through the rules, right? We want our IPS to be full of rules. So you might want to think through the rules that you're going to put in place that allow you to massage your excess capital up or down. I'm not sure you necessarily want to just willy-nilly say, well, I woke up this morning and I was a little bit scared, therefore I moved a few $100,000 into bonds. That to me doesn't seem too prudent, but if you've thought about it beforehand and it's there in the rules and then you just execute on those rules later on down the line, that's what, sound long-term investing is all about. I think it's time to go on to your second question, Aaron, where you said, do you take valuation metrics like the CAPE ratio into account when deciding whether to maintain a higher portfolio value than planned as a risk buffer? In other words, having a $1 million portfolio in 1999 would have played out very differently than having a $1 million portfolio in 2002. So yes, it would have, Aaron. In 2022, I wrote an article called Timing the Future Market, CAPE versus Returns, CAPE versus Future Returns. And we'll link that article in the show notes. In that article, I created a bunch of graphs that show the CAPE ratio, cyclically adjusted price to earnings ratio, CAPE, against the future earnings of the stock market. So for a little background, listeners, the idea here is that a high CAPE, a high price to earnings ratio, it means that stock prices are very high as compared to stock earnings. And considering that all long-term stock returns are a function of earnings, if the price for those earnings is high, we'd expect our future returns to be low. And if the price you pay for earnings is low, well, then you'd expect your future returns to be quite high. Indeed, that's exactly how the graphs play out in the article. You can see it for yourself. There's a very clear pattern. Higher CAPE ratios lead to lower returns and vice versa. But the CAPE ratio is not a perfect crystal ball. And there have been plenty of periods of time with both a high CAPE ratio and also excellent future returns. So to make an abrupt portfolio change based solely on the CAPE ratio could be a big mistake. There have been periods of time before where it would have been a big mistake, and to do so right now might be a big mistake. I'm not exactly sure. One big argument right now is that the CAPE ratio is not exactly the same as it used to be, and maybe we should think about it much differently. The argument is that technology changes everything. Think about you're in the mid-1900s, middle of the 20th century. Think about manufacturing. It was expensive for companies to increase their revenue. To increase, if Ford Motor wanted to increase its revenue, it had to go buy more land, hire more people, build more factories, more assembling lines, buy more raw materials. The future earnings of that company were tempered by the marginal cost of new profits. It cost a lot for Ford to go generate new profits. And the basic economics of that manufacturing economy kept CAPE ratios hovering between 15 and 25. The naysayers or the contrarians or the critics would say that right now, the 21st century is not working that way, that the basic economics of technology companies, these new era technology companies, is much different than Ford Motor Company. Software companies have these huge gross margins because it's so simple for them to just sell more of their product, right? Microsoft could go sell more software licenses tomorrow with the click of the button. They don't need more labor or more land or that much more of intensive capital investments. I know some people might be saying, like, what about these data centers, Jesse? I get it. That might be a little bit different. But to make a long story short, when it comes to comparing the CAPE ratio in 2026 against the CAPE ratio of the 1900s, some people would say that's like apples and oranges. Thus, they would say that our current CAPE ratio, which is about 41 as I record today, some people would say that it should not be seen as a signal of impending low returns, but instead as a new normal. Are they right? Well, I'm not really smart enough to say. But looping back to Aaron's question, He's correct that a $1 million portfolio at the height of the dot-com bubble, 1999, would have led to a much different outcome than a $1 million portfolio in 2002 after that dot-com bubble had burst. And his point is that once the CAPE ratios of 1999 came back down to earth, a retiree's future appeared more reasonable and optimistic. He's essentially pointing out a sequence of returns issue, though, right? Which is a good problem to point out, of course. And my solution to sequence risk, though, it's not about rebalancing rules based on CAPE ratios. Instead, my solution to sequence risk is to properly allocate enough cash and bonds to conservatively survive any sort of nasty stock market sequence. Other people add gold, other people add alternatives to accomplish this. But either way, the point is that a broader, more diversified asset allocation is my ideal solution to sequence of returns risk, more or less irrespective of the CAPE ratio. In other words, it's so common for investors like us to feel these conflicting emotions about whether to buy or sell or rebalance or reallocate, all of those things. I mean, my 2 cents, reallocation, moving a big amount of money from stocks or to bonds and vice versa, that type of reallocation ought to be due to a change in your financial plan, a change in your cash flows, a change in your future withdrawal needs. It's not about, I repeat, it's not about market performance. We don't reallocate money due to market performance. We don't change our target allocation based on market performance. Now, do we rebalance as a function of market performance? Certainly you can, but granted, you don't actually have to. Rebalancing was one of the main topics back in episode 138, if you'd like to check that out, episode 138. And one of the big conclusions was, from a Vanguard study, that the simplest and most effective rebalancing strategy is just to do it once a year, regardless of performance. Just rebalance once a year, and it's about as effective as any other rebalancing strategy out there. Anyway, if you're in doubt, which I frequently am, I found a lot of wisdom in John Bogle's famous advice, don't do something, just stand there. So Aaron, thanks for the interesting questions. Here's a quick ad, and then we'll get back to the show. Did you know my written blog, The Best Interest, was nominated for 2022 Personal Finance Blog of the Year, and it's been highlighted in the Wall Street Journal, Yahoo Finance, and on CNBC? I love writing, especially when that writing is to share financial education, and I usually write 1 or 2 articles per week. You can read them all at bestinterest.blog. Again, the web address is bestinterest.blog. Check it out. And last, Brad wrote in, and Brad said, when you're actively drawing down your portfolio in retirement, how do you actually implement dynamic spending in practice? Specifically, what triggers should cause you to cut spending and by how much? Well, a very cool question, Brad. Dynamic spending in retirement. So listeners, it's any sort of flexible withdrawal strategy where you adjust how much you spend each year or maybe each quarter or maybe each month based on, for the most part, it's usually based on your portfolio's performance. And these dynamic rules are in contrast to a fixed amount, withdrawing a fixed amount, which is what maybe the 4% rule might tell you. The 4% rule says, calculate 4% of your portfolio in year 1 of retirement, then adjust that number up by inflation each year, and that's your spending, like it or not. So the 4% rule is a static rule. And candidly, I think the reason the 4% rule is static is because when it was created in the early 90s, we didn't have the computing power to do any sort of back testing for dynamic strategies. So we were throttled down by computing power. We had to keep it simple. So we had a static rule, the 4% rule. And we aren't really throttled for computing power anymore. So we can start to look at dynamic strategies, which is kind of cool. Dynamic spending strategies generally say that you can spend more when your portfolio is up and that you kind of have to pull back the reins a little bit when your portfolio is down. And there's some common approaches. Perhaps the most common is the guardrails method, where you set an upper and a lower spending limit. If your portfolio grows enough, you give yourself a raise. And if your portfolio drops too far, you cut back. You only adjust your annual spending if you end up hitting those guardrails. Sometimes you can tweak your spending multiple years in a row because you bump into your portfolio guardrails. Sometimes it stays steady. Sometimes your spending stays steady for multiple years. A common implementation of the guardrail strategy is that when your portfolio grows by 20%, you increase your annual spending by 10%. And if your portfolio shrinks by 20%, you cut your spending by 10%. So a very simple framework. Another interesting approach was developed by Nick Majuli, former guest on the show, by the way, and Brandon Ganch, who some of you might know as the Mad Fientist. My understanding is that the mad scientist's main criticism of the 4% rule was that it wasn't designed specifically for early retirees. And he's true there. The 4% rule is designed for a 30-year retirement timeline. And if you retire at 40 years old, you might easily have a 50-year retirement timeline. Nick Majuli and the mad scientists created a different framework. They split a person's spending into a non-discretionary bucket, that's essential spending, and then a discretionary bucket, which they call lifestyle spending. And then their strategy varies or adjusts the discretionary withdrawals based on where the stock market is relative to the stock market's high water mark. So their first rule is that you always withdraw enough to cover your essential spending. After all, it's essential. But then their next rules discuss how much you're allowed to withdraw in order to make discretionary expenditures. And their rules are that in a bear market, when the market is 20% or more down from its all-time highs, that you withdraw zero for discretionary spending. You don't get to have any fun money during those times. During a correction, though, when the market is 10 to 20% down from its highs, you're allowed to withdraw 50% of your discretionary budget, so you can have some fun. And then all other times, you are allowed to withdraw your full discretionary budget. So again, if the market's down a lot, basically you can't have any fun. If the market's down a little bit, you can have partial fun. And if the market is close to an all-time high or just within 10% of an all-time high, you can withdraw your full discretionary budget. So why go through this? Well, they back-tested this strategy, and they showed that by following these rules, you could retire sooner at an earlier age, and or you could withdraw more money on average, since your willingness to be flexible on discretionary spending dramatically reduces your sequence of returns risk. And specifically, they showed that you could use a 5.5% withdrawal rate for a 40-year retirement, which sounds amazing. Again, the 4% rule says a 4% withdrawal rate for 30 years, where Nick Majuli and the mad scientist are saying that you can use a 5.5% withdrawal rate for 40 years. Sounds amazing. But the caveat is that half of the 5.5% is considered discretionary spending in their model. So that in bear markets, your 5.5% withdrawal rate actually gets cut down to a 2.75% withdrawal rate. There's really a flexibility requirement here. During a bear market, you're not taking any big trips. You're canceling the tennis club membership. You're not flying out to Illinois to visit your kids. During a bear market, you really are just throttling everything down to only the essential spending. Whereas for a static retirement rule, like the 4% rule, the 4% rule basically says, we don't care if we're in a bull market, a bear market, anything in between. You can always withdraw what the static amount is. You don't have to cancel your trip just because we're in a bear market. You don't have to cancel your gym membership just because you're in a bear market. Whereas these flexible rules often say, well, if the market's not doing well, you've got to make some cuts. You've got to make some sacrifices. It's a matter of taste. These rules aren't for everybody. That said, another interesting dynamic rule is the so-called ratcheting technique. Ratcheting is a direct response to the first two methods we discussed because many people have realized that cutting your spending feels bad. It feels bad if you have to cancel that trip. It feels bad if you can't visit your grandkids. It feels bad from my seat. If I'm someone's advisor and I have to tell them to cut their spending, it doesn't feel good. So like the ratchet in your toolbox that only turns in one direction, this ratcheting technique in retirement has triggers that allow you to increase your annual spending, but promises to never ask you to decrease your annual spending. The ratchet, of course, therefore has to start relatively low because if it's only ever going up and if it's never coming down, you kind of want to be cautious about that. But a simple ratchet would be to evaluate your portfolio throughout retirement and to always reset your spending to the 4% threshold if it means that you can increase your spending. Now, what exactly does that mean? That might have sounded a little confusing, but let's say you start retirement with $1 million and the 4% rule says you can withdraw $40,000. So you withdraw $40,000 in year one. And after 1 year, the markets are good for you and your portfolio grows to $1.1 million. That's totally reasonable in the world of investing. Well, 4% of 1.1 million is now $44,000. So year one, you withdrew 40, and maybe after inflation in year two, it'd be like, yeah, you can withdraw 41,000. But if your portfolio is at 1.1 million and you simply reset the 4% rule at your new portfolio amount of 1.1 million, you can withdraw $44,000 that year. So you could ratchet up your annual spending to $44,000 and essentially reset your 4% rule. If you're interested in learning more, I'll link an article in the show notes that I wrote, and it's called Should I Reset My Withdrawal Rate During Bear Markets? And it dives into this exact subject. That technically speaking, you can ratchet up your spending multiple times in retirement if your portfolio merits it. So Brad, back to your question, what triggers should cause you to cut spending and by how much? Well, my real answer there is it depends on what strategy you're using, and it depends on how it's performed during back tests. So here's one data point for you. The original Guyton-Klinger work that created the Guyton guardrail system was based on one check-in per year. Once per year, you look to see if your portfolio is actively violating a guardrail, and then you adjust your spending accordingly. So what's kind of interesting there is that your portfolio could have been violating a guardrail for most of that year, but then gotten back on course just as you checked in, and thus you wouldn't have made a change in your spending. Or vice versa, your portfolio could have been just fine most of the year, and then just snuck into the guardrail area around the time of your check-in, and now you're making a spending adjustment for the entire next year. It's just the way the back test was conducted. So again, my suspicion is they had limited computer power and thus limited ability to try different back tests. And this shows that some of the sampling error, for lack of a better term, when it comes to financial planning research, it's not always perfect. And as I was reading in preparation for this episode and this question specifically, I jotted down some thoughts for any of you considering a dynamic withdrawal strategy. So here goes. Step 1 is to set your trigger in advance. So I think the biggest mistake to make when it comes to dynamic withdrawal rates is to make a withdrawal decision or a change in the moment. You don't want to do it in the moment. You want to write down your rules up front. The second thing, if you're considering cutting your spending, how much will you cut and why? That's probably obvious. But the guardrails approach is the most cited framework here. And my opinion is that the cut should be uncomfortable, but obviously it needs to be survivable. So one of the big pushbacks against Nick Majuli's work and the Mad Fientist's work that I mentioned before is that they used a 50% spending cut as part of their proposed strategy. And that's a massive cut. It's a massive cut. And when you're talking about uncomfortable but survivable, I suppose that might be a survivable spending cut, but it's just so uncomfortable that you probably don't want to cut your spending by that much. The third thing to think about is your frequency of review. So how often are you deciding to increase or decrease your spending? This will vary based on your approach. I think some people think of their finances as a monthly endeavor, and that monthly approach might make sense for them. I would wager for most people, monthly is too frequent. It's too easy to get caught up in your head if you're just like every single time it's the 30th of the month, I have to decide how much I'm spending next month. I think that's a little bit too much. So I think a quarterly or a twice annual or an annual approach would make the most sense. Fourth step, this one's probably obvious too, is just figuring out how you are putting your spending into different tiers. What are you cutting versus what are you not cutting? What's truly discretionary? What is lifestyle stuff that technically you would cut but you'd rather not versus what are the core things that you just simply can't cut out of your budget? And then my last little pointer to think about, the fifth one, is to think about the recovery side of dynamic spending. So Michael Kitces has done some really good research on this topic, showing that for some dynamic spending systems, in some backtest periods, there's a really big downside of dynamic spending. And that downside is that following these kind of rules would have you throttle down your spending for years and years and years, even though eventually, with the benefit of full hindsight, it would have turned out that your throttling down wasn't required in the first place. It would have maybe felt necessary in the moment, but then future later market recoveries would have made it seem totally unnecessary and futile. And the research suggests that most retirees underspend. They underspend in market downturns much more than necessary, and they do so out of fear. So having a pre-written plan with specific triggers actually gives you permission to keep spending until the trigger is hit, which is just as valuable as knowing when to cut. So in summary, dynamic spending rules are interesting. I still have a little hesitation though, because for the most part, you're sitting there as a pre-retiree and you're creating a set of rules that you are convinced are going to dictate the following 40 years of your retirement. It's still a little bit too locked in. I think rather than creating one set of rules that then you follow for the next 40 years, I think there's a different way of doing it. But still, I get the point. And I think no matter how you approach it, whether it's a static rule or a dynamic rule, I think you do want to convince yourself, obviously, you have to convince yourself before you retire that your retirement plan is successful based on some of these rules. And then all I'm saying here is that you have to, I think, admit to yourself that you might be 3 years or 5 years or 10 years into retirement, and you might say, you know that rule I thought about 10 years ago? Turns out my life has turned out a little bit differently than I thought. That's just the way life goes. That's just the way the retirement goes. So set up some rules, convince yourself that your retirement plan works for those rules, but then accept the fact that life throws you some curveballs and the rules might not matter. So thank you for the great question, Brad. That was awesome. If you guys listening have a question to submit to a future AMA episode, please, you can go to bestinterest.blog, and I now have a submit a question right there on the homepage where you can go submit your question. You can always email me to jesse@bestinterest.blog. Thank you so much for tuning in today. Subscribe to my weekly email on the homepage at bestinterest.blog. If you really love this podcast, you can leave a rating and review on Apple Podcast app. And if you're interested in learning more about my retirement planning practice, you can visit planwithjesse.com.
Thanks for tuning in to this episode of Personal Finance for Long-Term Investors. If you have a question for Jesse to answer on a future episode, send him an email over at his blog, The Best Interest. His email address is jesse@bestinterest.blog. Again, that's jesse@bestinterest.blog. Did you enjoy the show? Subscribe, rate, and review the podcast wherever you listen. This helps others find the show and invest in knowledge themselves. And we really appreciate it. We'll catch you on the next episode of Personal Finance for Long-Term Investors. Personal Finance for Long-Term Investors is a personal podcast meant for education and entertainment. It should not be taken as financial advice, and it's not prescriptive of your financial situation.